Good morning, everyone. Welcome to the live stream where we're going to talk about stocks, stock investing. We're going to look at stocks and review them, review their fundamentals, try to price them based on their future free cash flows and their future profits. We're also going to look at the technical charts. My colleague Daryl is going to be taking a look at charts as we look at these stocks and see what they've been doing, see if they're setting up well. How you doing this morning, Daryl?
Doing wonderful, Victor. It's great to be here. Hello, everyone.
It's an interesting market here in 2026. We've had three excellent years in 2024, 2025, and I missed 2023, 2024, 2025. And this year, I can understand some sectors giving up their gains, and we've seen a pretty good rotation year to date, where we've seen some um, pretty well-known names give up some of their market cap and that money flowing into other areas. Looks like consumer staples is going up a bit. We are investing at this time with an elevated VIX, showing that investors are a little concerned. And elevated VIX, I think it was above 20. It was like 20.9 when I glanced at it earlier today. What does that mean to you when the VIX is reading at a little above 20?
They're pricing out volatility of options over the next 30 days. But what the number actually implies, like if it's sitting at 20, it was just a little above 20. That basically equates to volatility of 20% over a 1 year time frame.
Yeah, and the economic data we're in a my observation, right, is the data shows that the economy isn't booming and the economy isn't struggling to the point where we are in recession. So we're kind of like in between those 2 points. The good news about that is I don't think inflation is going to be pushed higher. I think inventories are fine. Prices are going to be somewhat stable. Some commodities could be, go up or down at a much higher rate, but commodities tend to do that.
Yep.
For example, oil has been going up. So that situation is somewhat good news to me that, hey, okay, inflation's not going to be this big giant problem. We could expect that, hey, we're just going to kind of keep growing at a slower rate. It doesn't mean that every company is going to grow at a slower rate. My intent is to find businesses that are growing faster, that are growing their profits faster. When I define what's desirable about a business, it's to find those businesses that are growing faster. And there's a lot of businesses that are growing quite well right now. And the task for me is to go find them, make sure that I understand what they do as a business, value them, and then buy them at the right time. In most cases, I make good money and I have good appreciation under those conditions. Looks like materials might be the best sector this year. They've done great, especially silver, gold. Copper had been doing well, although copper has come down a little bit. The industrials have done great. Deere has been doing great. It produces big machines, big machinery, and it's been doing great. So has Caterpillar. GEV's been doing great. They produce a lot of turbines that are going to be used to generate power. And a big part of what's moving stocks higher in general over the last 3 years has been the investment in the data center. Undeniably, that's where a lot of capital is going. So it'll be interesting to see how things play out. Looks like DJ is on, Alex is on. Good to see you guys. And we have a couple of new members, and one that is highlighted on the stream is going to be Eddie Astor. Thanks so much for becoming a member. Really appreciate it. And on this live stream, as well as any live stream, if you ever wanted to look at a stock, you just put it in the chat and we could look at it. We'll look at the fundamentals. We'll look at the valuation of the stock, and we'll look at the charts. And feel free to do so on this stream or any other stream. Looks like DJ is on. Target versus Costco. Oh man, we got a cage match on our hands.
Let me
Target.
get my boxing gloves here.
Yeah. Versus Costco. That's a good one. I did a video. I completed a video on Walmart earlier when they announced this week, and I released it to members. So I'm somewhat ready to go on this request. So we can take a look at that, DJ. Good to see you. Dwayne, good morning. Good to see you. All right. So what other economic news is out there? So we've got a market year to date. This has kind of been, depending on where you're invested, right, is the market's struggled for some sectors, software being one of the big struggle areas. But in general, the market's up a little bit, which is interesting, right? You got here's materials, communications, all these different sectors. Now, one of the things that I would want to talk about is from a long-term investing perspective, this could be a difficult year for some sectors, but it shouldn't change my investing methodology, and it shouldn't change my like or dislike of certain sectors. What are some sectors that I like? I like sectors that have companies that have high rates of growth, and those companies have high margins, high gross margins, high profit margins, have high rates of free cash flow generation, and they just constantly get bigger in revenue size. They get balance sheets that have more cash, and that cash becomes a big, obviously an asset, but it enables that company to grow, acquire other businesses, and so forth. And I, this year specifically, find myself looking at businesses that fit the criteria of companies that I like, and they're discounted. So I know a lot of you have been on these streams for a while, follow my methodology. And 6 months ago, I was complaining that I couldn't find that many discounted stocks. Now I can find plenty. And as stocks sell off, they get even better. And what's good about earnings reports is as these companies announce, it further validates that a particular business is a good one. Like, hey, they keep growing and they keep getting stronger, better. And we've seen some stocks really move higher on their earnings announcement. We'll take a look at DoorDash if we have time later. I wanted to look at that business. That business has those characteristics of high growth, high profitability, high free cash flow, and it's a very low capital intensive business. And I've been fairly busy this week trying to keep up with all the other earnings announcements. So I haven't had a chance to look at Dash. So I wanted to look at Dash because some of the notes that I've seen is that Dash had a really good earnings report. So we'll see how good or if it was just okay. And Daryl wants to look at KOKE. We can take a look at that.
COKE.
COKE. And what is that company?
They're the bottler for Coca-Cola.
Right. Okay, perfect. So it should be a fairly stable business. We'll take a look. Yeah, so the year, it may at times feel awkward or like, man, my portfolio isn't really performing all that great, but I shouldn't change kind of like, what's my goal is, well, I want to own these great businesses that 10 years from now, my portfolio is going to be worth 3 times as much. That's my goal. Compound it. And I can get there if I own these great businesses. I try to use the I guess the knowledge, the advantages I have in the market. And for me specifically, I have professional experience. I've experienced in some industries. I find it really interesting to dig into how a business functions, how they're trying to grow. I have an accounting degree. I've worked in corporate accounting, so I can read through financials. So I use my strengths to try to have a methodology and a strategy that will, over the long haul, be successful. That shouldn't change, even though this year has been kind of a whirlpool of things going on. The technology sector's seen a rotation. It's been interesting, and it may be a big opportunity that's staring us in the face. We'll see. It takes a year, maybe two, maybe three to figure that out, to see it play out. So those are some opening remarks. Anything else just to open things up, Daryl, that you want to mention?
Yeah, so you mentioned the VIX. I'm also seeing the put call ratio is still pretty high. It did come down a little bit the last 3 days, but it's still at a pretty high level. So people have bought some insurance for a down market. We'll have to see how that plays out.
Yeah. And I appreciate the comment from James. And, uh, I right now we're not dealing with really with any kind of like big giant like correction, right? But we had a giant correction for COVID, and that was scary in a lot of ways. It's like, whoa, what the heck's going on? 2022, before that, the Great Recession of 2008, and then the dot-com bubble bursting. Now, referring to the Great Recession and the COVID correction, right? So the Great Recession's here, and we had a very, very bad market. It was horrible. And speaking about real estate, because real estate led that giant recession, I should say assets that were in the real estate market and the loans against a lot of those assets. And I remember hearing stories. I couldn't believe people could put this out on their news channels. Oh, will real estate ever recover? They were implying that real estate was going to go to zero. And it's like, you guys are crazy. People live in their houses. They treat, for the most part, households, their biggest asset is going to be their home, right? So to say I doubled down is an understatement. I scraped together all the capital I could. I bought more stocks, and I bought 5 investment properties for real estate. That was a real wise thing to do. It played out really well. But during that time, I had educated friends who were like looking over at me going, "Are you crazy?" And they were not, investors. They were more like just average, smart people. And I'm like, well, I think it's going to play out so that it really bounces back well. And it certainly did. So that played out to be that when it was absolutely horrible, when it was absolutely least comfortable to buy into stocks and assets, was particularly the best time to buy. It's like contrarian emotional feeling. It's like when it's horrible, it's great to make money. When it's great, it's going to be hard to make money from an emotional standpoint. Like if things are booming, my spidey senses begin to think, man, we're setting ourselves up for a nice little correction. And of course, we got fast forward to COVID. We had a flash kind of crash where, what's going to happen with this, pandemic? And it was really weird. And I did not sell any stocks. I just invested more. And at this time, it was like the behavior of the market changed so fast because over here we were just kind of, cranking along, going up nicely. And then all of a sudden, wham, we had this correction and you had everybody at home. So I think the retail investing community expanded. There was far more people that were investing, which is great. And away we went. It really cranked up until the beginning of 2022. And then we had the invasion of Russia into Ukraine. Oil prices spiked. And oftentimes when oil prices spike, we get a recession or the market sells off. And we had this here. And here was an opportunity to buy really good names. The best name that I bought was Meta. I've done great with that investment and it's really boomed. But you see how like the pitch of the chart really goes up from the 2020 at peak before COVID. The rise in the S&P is 112%. So that would be roughly, I guess, about 6 years. That's phenomenal. That's really, really good. Do you happen to know what's the average S&P performance per year?
I think it's about 9% on average over the last, since its inception. I think it's been about 9% a year. I probably have a chart for that. Let me see, long-term trend channel.
Let me get Gemini in the game here. Sometimes here it is. So we're right there, 10% before adjusting for inflation. Okay. So I guess over 6 years, and you got to compound. So at 9% over 6 years, I'm going to guesstimate that would be more like 75% appreciation is what we would expect. So we are running a little hotter than expected. All right. So now we're dealing with this like hard to understand kind of correction in some sectors. At least it's hard for me. Like, okay, when is software going to bounce back? Meta is, I think, discounted as well as some other stocks. The market's just like unsure of itself. And it might be because the last 3 years have been so darn good that investors are like, hey, I'm not going to get greedy. I'm going to put some of that stock into some cash balances and wait this one out till it's clear as to what's going to happen in those markets. So that's what we're dealing with now. And, this year would be a good year to accumulate into companies that I really want to own. So it's time to do more homework, more focus, more analysis. All right. So we are getting a good crowd. Good to see you, Zubio. And I could definitely look at Okta. If you want to buy a super chat, $5, I could do that, or you become a member and then you can request a stock ticker. Thanks for joining the stream. All right. To get things going, let's take a look at Target versus Costco. So I think most people know what Target does. They're a big merchandise retailer. Year to date, the stock's up 18%. Over 3 months, 30%, and then 6 months, 10%. 1 year, it's down. 5 year shows where Target just began to really fumble their business plan a couple years ago. And before that, Target was like, I'm going to say, one of the top performing retailers because they were perceived to be, hey, Target is they got a catalog that is better than Walmart's. It's almost like, Target was perceived to be a little bit better, so they could charge more price and they could have better margins and so forth. And they were growing better. And then at some point, they fumbled the ball, basically. This made sense. Okay. This is rational. This is like, okay, they needed to get their act together. So I think they have a new CEO. I think they've gotten their act together. So far, so good. But let's see what we're going to look at from a valuation perspective, and we're going to look at their forecast. Then we've got the very well-known company in Costco. Costco is, I think of them as like just a machine. They tell you what they're going to do. They do what they were going to do. And there they are. It's interesting that, they do so much volume. Now, this one hasn't been a superb investment over the 1 year, down 6%, even though they haven't really had a business problem. I don't think Costco's, blundered at any point in the last, I don't know, 40 years. Seems like they know what they're doing. They understand their business. They keep doing what they know they're supposed to be doing. They keep doing it better. That's Costco. But the stock did get a little pricey. Okay. I'm a Costco customer. I like shopping at Costco. Sometimes it's a full contact sport, if you know what I mean. And sometimes if you sneak in there and get in and get out, you're like, whoa, this is great. Couldn't it be that way every single time? But the deals and the value there is so good that my wife and I continue to have our membership. We go buy our stuff there, and we're very satisfied customers. And my wife even shops like the big ticket items. I think we got our auto insurance there, and she got the best terms from the Costco offered insurance. They partner with somebody else. They partner with an insurance company. And she's even looked at the vacation packages that they have there. We've never taken one of those, but that's to the extent that we're Costco customers. We're also Target customers too. And Target is more of the daily necessities kind of thing. All right. So these are two well-known stocks. The valuations are very different. Costco, $438 billion. That's a pretty big, valuable business. Okay. I think it's top 25 most valuable businesses listed on the stock market. Very small dividend. And the P ratio is 47.89. Now, it's just my observation preference, but if I'm going to pay a high PE ratio, I want to buy a business that is really profitable and growing. So Costco is growing 8% on a big business. That's good. It's not great, but it's good. Margins are not good. I'm not going to sugarcoat it. 13%, just not. It's not like a booming business, or excuse me, a very lucrative business like NVIDIA. When they sell GPUs, they get a 75% gross margin. And I can go on and on. When Facebook runs, their ad business and so forth, they get 82% gross margins. So if Meta sells $1 million of revenue, the gross profit portion of their sale is more than $800,000. Costco would have to sell basically $5 million to have about the same amount, or actually more than that, like more like $6 or $7 million to have the equal portion of gross margin as Meta. So this area here has always been an area of, if I had my choice, I'd rather buy those businesses that make a lot more money because their profit margin is really low. The free cash flow margin is really low as well. So that's been an area of just undesirability for me. And that's how I invest. Some investors have done well with Costco, but not for the last couple of years. I respectfully have been making videos on Costco for the last 2 years, respectfully saying that this is a great business. It just seems too expensive. So as we look at the forecast, we are in the year that's going to end August 31st. They're going to be a $300 billion revenue business. They're growing their profit. The P ratio is just too high. And I think the reason it's high is some of these stocks are easy for the investing community to understand, very comfortable for them to buy. Like, hey, Costco is always going to be in demand. So they buy Costco. Okay, cool. I get that. So that's why I think the elevated PE ratio is out there. It's priced at a premium because of people's comfort level. All right, so let's take a look at Target, and then we're going to look at the valuations. So Target is a much lower market cap. That 5-year pain and suffering zone that we saw has brought down the stock price for Target, brought down their market cap. So as we saw, Costco is 8 times higher in market cap. P ratio 15. Whoa, wait a second. Costco is way up there at 40 some odd PE ratio. Now we got 15. 15 seems like a sensible P ratio for a retailer. And when we look at their growth, this is where the opportunity for me, I believe, begins. Negative, negative, negative. Okay, but let's look forward. This is the looking through the rearview mirror, seeing that, hey, Target has had its troubles. I agree. And I think some of that price reduction in their stock price was deserved. Let's take a look at the quarterly. It's beginning to flatten out, and then we'll look at the forecast in a bit. So we saw that Costco had margins that were really low, and Target margins are twice as high, gross margins. And their profitability is there. It'd be nice for them to get to like 6% profit margin, and it'd be good to see them increase their free cash flow margin. And when we look at the forecast, this is what led me to be optimistic about Target. Green on the screen here. Okay. And Target is, their catalog is not like, they're selling like ultra premium luxury items. No, they're selling the stuff that most people need. And I think their catalog's quite good. They're selling food, which is a good idea to get foot traffic in the door. So if they start to grow, I think this is going to create some positive stories. They're also going to grow their profit, bringing down their PE ratio. So if I compare the two, I'm comparing Costco versus Target. I'm buying Target at a fraction of the PE ratio. I'm buying it at about a third. If you compare PE ratios, I'm buying a PE ratio that's far lower for Target, and I think has a very good upside potential. So let's take a look at valuations real quick here. I got them both. So Costco, in my opinion, is priced 37% too high because people like the stock. They think it's a real solid business. Can't argue with that. I think it is a solid business. You're just paying a premium price. Like Toyota cars, they deserve the brand and the respect they get because it's a really reliable car. Get that. You might pay more for a Toyota. Got it. That's a little bit like with Costco scene. But I'm trying to make money, and I started buying into Target really about 3 months ago. So the discount's still at 14, but this was a good. See, I started investing in November, and I'm already up on the stock. It's still discounted. I think the news is going to continue to get better, and their fundamentals are going to continue to get better. So the choice between Target and Costco for this investor is I'm buying Target because I think the next couple of years are going to be very profitable for me in Target. Next couple of years at Costco, I don't think are going to be as profitable. I don't think the stock price is going to go up as much. It may even just go sideways. That's what it's been doing for a year. And Target, I think, was a successful find, a successful observation, analysis so far, right? The game isn't over yet. We got to see this stock go higher. But in my opinion, as I looked at Target, what I wanted it to do, you see that it hit a peak of $260 per share. And I think that Target could get $200 per share. That isn't even close to their high that was achieved in 2021. And I think it's going to get there. It's going to get close if they execute, if they get the job done in their strategy. So there you go, DJ. That's my part. But let's turn it over to the charts. And Daryl's going to go through the charts for Target and Costco.
So we'll start off with Target. I'm in 5 years daily. Market just opened. I saw the price change. They've been in they started a decline back in 2022. So this red line right here is the 200 day. So that is a confirmed downtrend that reversed in early 2024 and then peaked out at the end of 2024 and then started another decline. So they haven't turned that around yet. The prices are improving here recently, but they are in still a confirmed downtrend. I put the Fibonacci levels over here, basically near the bottom that I saw here and near the top that I see here. And the reason for putting these here is these are going to serve as resistance points. As the prices move higher, there'll be a battle at those particular levels. So if I just set my crosshairs there, I'm setting it right on that 38.2% retrenchment level. You can see that that was basically a price where they were consolidating for quite a period of time. If we move up to the 50% retracement, then we're at the high that we saw in 2024. We move up to the 61.8% retracement. We're right at where it broke down in 2022. So on these longer term trends, I like to have the Fibonacci there just so I can easily spot out where they're going to find some resistance as they battle their way back from these lows. So we'll move to just a 1 year chart. So they have reversed this downtrend. It looks like it bottomed out the beginning of January and they are moving higher. They're above an upward sloping 21 day, 50 day, and a 200 day. And we did get a golden cross where the 50 day crosses the 200. So they are out of the confirmed downtrend and it looks like they are moving higher. This downtrend line is going to be a point of resistance as well. They do have an RSI that's sitting at 62. So that is good.
I have something to mention, point out, or maybe ask a question around when you're ready.
Okay, go ahead.
So as I look at the left and I look at, the stranded lows, I guess, a lot of people bought at the lows.
Yep.
So there won't be any like selling pressure because investors like, all right, cool, this stock's working. They'll probably be like more of a fan than they will be. Well, this one kind of changes the game a little bit.
Yeah, you have to go back when you're looking at that because these people aren't stranded. It's the people that bought 4 years ago.
Yeah.
At these prices, what are they going to do? Are they going to be sellers?
Well, psychology wise is like, okay, at this point, like looking at the 3-month on target, it's up 30.5%. It's like, okay, that's telling you that the stock is working. So you're going to sell a stock that's working, and then where are you going to take your money to? Right now, a lot of things are not working. So interesting to see. Carry on, sir.
Okay, so let's go back to just 1 year. The RSI got a buy signal at the beginning of February. We had a short term where they were in a sell signal. Accumulation, let's go back to 5 years to get a look at the accumulation. So they had peak accumulation in 2023 and they'd been on pretty much a downtrend. And back in November of 2025, we did start seeing a bit of accumulation. Not near the levels that they were in 2023. Okay, so we'll go to 1 year. The money flow is bullish at the moment. So I think at the moment they are looking pretty good at the moment. Just keep in mind they're going to be facing a little bit of resistance here. They're basically about 20% above their 200-day moving average. This will act as some gravity at some point. We go back, look at 5 years again. I mean, they traded pretty much all the way under their 200-day for a year, got above it. They were extended here about 33%, and they finally, the 200-day actually caught up and they decreased in prices and met that. So just keep in mind when they get extended like this that there is a tendency to gravitate back to that 200-day moving average at some point.
Mm-hmm.
So that's a target. If we look at Costco, I was an investor in Target and finally moved out. I am an investor in Costco and continue to be. The Target chart will not look like this over 20 years or 19 years. So basically over 3 years, their price is appreciated about 65%. Divide that by 3, and that averages about 20% or so. But they travel within this long-term trend channel. They're kind of at the upper end of it at the moment. So on a relative basis, they are expensive right now. You like to kind of wait till they get back down to the middle of this channel. And this is when I picked up Costco, is right in here. So my price is about $600 or so, 668. So I trade this one off and on, but I like the long-term trend channel. Let's just put Target in here just to see. No bueno. So you got to buy this one at the right time and you have to watch it. Costco is more of a, you can almost set it and forget it.
But if you stay on this chart, if you could stay on this chart for a minute, I get that. So when I look at charts and I think about a business, Target being a really good example, is do the charts represent what is actually happening with that business? Are they fumbling and making mistakes, losing market share, revenues going down when historically it was actually a higher growth stock, a higher growth general merchandiser versus its competitors? The last 5 years, they have operationally been missing. They've been striking out. So the last 5 years, this chart makes complete sense. But let's go back to 10 years ago. Target was clicking. They were operating well. They were growing faster than their competitors. And the chart shows that the stock really flourished. So it's all in Target's hands. If their management team is able to grow this business, I'm expecting a chart like what we saw between 2015 and 2021. That's where the stock's going to go if they execute. You don't execute, you're going to pain it. You're going to be in a pain and suffering trend. That's, to me, that's the way it should be. Is if businesses operate well, if they accomplish the objectives they've set out, stock goes higher. Hey, perfect. So far, so good. It's early. So I think that I like this chart a lot. I can't argue with the Costco stock. It's the Costco's Costco. It's like a gold standard of retail, right? They created a new category, I don't know, 40 years ago, 50 years ago, and have really just stuck to it. They stuck to that model. That's who we are. We have the membership program that is all profit. The members are glad to pay that amount. Amazon copied them, and Amazon created the Prime membership. Now Amazon makes all that money, and pretty much it's all profit. Great charts. Keep going, Daryl.
Yeah, the nice thing is they are at the bottom. We could negotiate on exactly where these lines should be, but I'm just trying to connect as many points as I can, and that looks like a pretty good line. I just made a copy of it and drug it down, trying to connect as many of the bottom points, ignoring these overshoots and undershoots, because this was the great financial crisis, and this was the rebound out of COVID.
That's when people are going to Target and getting like, 5 bundles of toilet paper. And,
yep, exactly.
That kind of behavior.
And then I made another copy and made it a dotted line and just put it in the middle. So the opportunity here is, as Victor is saying, is there at the bottom of the channel. Costco's at the top of the channel. Just keep in mind there's a lot more volatility with this one, even over all these years. This is 25 years worth of data.
Mm-hmm.
And so there is a lot more volatility here. You have to watch that one. Costco, there's always some opportunities to buy it. I bought at the end of 2023 after it had consolidated basically for 2 full years. When it broke out above this consolidation, I was buying right here and have been trading it ever since. And if I go into just 1 year, I mean, it gives you some opportunities every once in a while. This is weekly data. Let me go to daily data. I called this bottom here within 2 days. On February the 19th, I put out a video saying I did some analysis on all the volumes over 20 years. Whenever you see huge spikes in volume like this, it's a capitulation. Costco. Not all stocks are like this, but with Costco over 20 years, every time you saw volume this high, you were within a week of the bottom. This one I called within 2 days. It actually went down for 2 more days, but then it shot up 20% in about 6 weeks.
Nicely done.
So you got to keep an eye on your stocks and make sure you're watching them, because this was a great opportunity to pick up some shares in Costco.
See, that's the game I like to play, is exactly what you're showing is, wait for the right time, pick up a stock, a business that you really like, and then you see a gain. It's nicely done, sir. The last thing I'll touch on, looks like DJ thinks, tariffs, as tariffs go away, these 2 businesses should do well. And I think the tariffs are kind of, not that scary anymore. It seems like US and China are figuring things out. So I think the tariff thing isn't going to be a big giant mess anymore. That, hey, we're seeing big giant tariffs. They're going to squeeze the margins out of Costco, Target, Walmart. And I think especially the big guys, they can kind of push that back to their suppliers and say, hey, temporarily, you need to eat the tariff, or we're going to put somebody else on the shelf. And those vendors are like, yeah, we'll do it, because we don't want to lose the shelf space. All right. So we got some more comments here. And one last thing on Target versus Costco. The dividend, very different situation on the dividend. for all your income investors. I don't invest on dividends. It's just an extra, it's a plus. But when I started buying Target, it was a north of 5% dividend. And Costco just it's a great business, but as you know, Daryl and I probably concluded it's a little expensive right now. And the dividend's 0.5%. So this is not like, okay, great. You know what? I'll just live off dividends for Costco. Boy, you got to buy a lot of stock to do that. But if you bought at the right time, north of 5%, you're beating the treasuries. So you're kind of got like a treasury yield here, and you're seeing a rise in a stock. Sometimes I just feel like stock investing is so like fun and gratifying. This is why, is when you connect on the right stock, you start buying into it, and you get, rewarded in multiple ways. So there you have it, DJ. Thanks for getting us all riled up with the cage match. Target
While you're
versus
speaking
Costco.
about dividends, let me show my screen one more time. And I'm not making a case one way for Costco or Target. They're both good companies. I think Costco is a little more stable and reliable, but it all depends on when you buy them and what the situation is at that time. Costco they have a lower dividend yield, but they pay out these special dividends every few years. So the last time they paid out a special, it was $15 a share. The previous time at the end of 2022, it was 10, and in 2017 they paid out 7. So it's about due. We keep talking, us Costco shareholders keep talking about when's the next special dividend. We keep expecting it, but haven't got it yet. But
maybe they're going to ask for a bar of gold.
yeah,
Hey, that's a bar of gold.
Yeah, they will do it eventually. But that's kind of a nice bonus to get these special dividends every 3 or 4 years or so on average.
All right. Excellent. Thank you, sir. Okay, so we've got BSX on the list. We've got Zeta on the list, but right now we're going to focus on Coke. COKE. And I think Daryl mentioned this is the bottler. Coca-Cola Consolidated Inc., together with its subs, manufactures, markets, and distributes non-alcohol beverages, primarily products of the Coca-Cola Company in the U.S. It operates through non-alcoholic beverages in all segments. Okay, so we know what these guys do. They're the bottler. Been around for more than 100 years. And over the 1 year, this is, I think it's a consumer staple, right? Yep, consumer staple beverages. And they've done well. Man, the 1 year looks really, really good. And the last 3 months, consumer staples have done well. So it looks good all the way around, and it's up a lot. Wow. They announced on the 18th, a couple of days ago. The market cap, 12.2 billion. So it's smaller, way smaller market cap than the Coca-Cola Company. P ratio, 25.9, small dividend. And when we look at their growth, just really consistent growth. They just announced, so the growth was really good, 9%. Whoa, everybody's drinking something. Coca-Cola, they're drinking something that they're bottling. And looks good. Good growth for a consumer staple. It looks real good. Let's take a look at their profitability. Gross margins, 39.7. It's not bad. Profit margins, call it 7.9. Very good. Free cash flow yield, very good. These numbers look really good, especially if you consider they've been growing that free cash flow. So they're not having to rebuild the factory every year. They're probably just having to maintain it really well. So these numbers look good to me. That's why the stock's been working. The market probably looks at these numbers and says, hey, I can duck out, go into a lower risk stock. Everybody's going to be drinking some kind of beverage. And these guys will probably deliver a nice return for me. And if that investor was absolutely right. So it's a good looking stock for somebody who wants consumer staples. I'm not a big beverage investor. It's I think Coca-Cola is too expensive for me. Like just a stock that a lot of investors own, like Warren Buffett. And this one here, though, is a pretty good little idea. And let me kick it over to Daryl.
So I get asked about this one every couple of months or so. So I track this for a friend. But I was asked about this when somewhere the end of October. Where did I think the price was going? So the first thing I noticed is there was a big basing pattern over about 5 or 6 months. And then we had this pullback, and then it broke out above the right. This is called a cup with handle. It did break out above the right rim of the cup. That's your trigger point. So basically, you can take the price at the right rim of the cup, subtract the price at the bottom, and add it back to the price at the rim of the cup will give you a price target. So at that point, I told this buddy of mine that I thought they would get to 162. They ran up to 167 in about 5 weeks. I put this Fibonacci retracement here from the right rim of the cup up to the price target that I had, so I could see where the resistance points would be, and it just blew through those like it was butter, knife through butter. Then they consolidated. Then they started another basing pattern. So he asked me on the 17th, so 3 days ago, what I thought, because he was talking about trimming here because it had gotten to an all-time high. And I said, well, I'm seeing a basing pattern. I'm seeing the same exact thing I did over here on a much shorter time frame, so it's not quite as reliable. But just take the price from here down to here and add it, and you'll get a price target of 185. That was 3 days ago on the 17th. So from the open to now, they're up 10% in 3 days. The RSI was positive and above 50. The PPO was strengthening. They were under accumulation, had positive money flow. So basically, what I suggested is there's no indication on this chart to tell me to trim. I would not be trimming if I owned this. Sure enough, so they're only about what, $2 away from their, or are they hitting it now? Yep, they've already hit it. So in 3 days, they hit that price target that I calculated 3 days ago. So this is a pretty amazing chart. Been fun to watch.
Look at that. Yeah. Amazing.
And tell me technicals don't work, everybody. I hear it all the time. They don't work. They don't work.
Well, when they work, they work.
Yep. They work the majority. They work the majority of the time. They don't always work. I will concede that, but they work the majority of the time.
So Dwayne wants to talk a little Zeta, and Zeta is a company that resembles AppLovin. They play in the ad tech space where obviously businesses are advertising online, whether they advertise on Facebook, Instagram, even TikTok, and Netflix and Amazon streaming services, all kinds of stuff going on online. And these businesses help other companies advertise online. And they are very highly discounted, 55% discount. So keep that in mind as we look at these charts. What's going on in this market? Well, the market believes that software stocks, and this one here is going to be put into the technology software infrastructure space, that AI is going to hurt these businesses some way, somehow. Maybe the competition to get into this space and compete against Zeta is going to be more prevalent as businesses compete against them. And that might be the case, but it's not for sure. And the other thing about it is Zeta can use AI to improve their business, lower their costs, make themselves stronger, better, faster. And right now, the stock over the 1 year is down 31%. It's had a good 5-day existence here. It's up nicely today, up more than 1%. And over the 5-day, it's up 6%. It's rolling towards its earnings. It's going to announce on 24th. So it looks like it's going to be Wednesday when they announce. This business is a small cap. If AI ends up being it did affect businesses, but it didn't put them out of business. It didn't affect them fundamentally. It didn't hurt them in a big way. It just kind of made businesses adjust. This stock's going to be worth a lot more. This company's going to be worth a lot more. On the other side, if AI ends up, Facebook with AI agents that they provide their customers, they don't need a company like Zeta. Same thing with Google. Same thing with where these companies go to advertise. The place where they advertise may offer them like, hey, well, you can pay Zeta, feel free to do so, but we got all these free tools that do just about the same thing, maybe even better. There's better return on investment there. That could really hurt Zeta. So which one's going to happen? We're going to need to tune in for the next 2 years to find out, because I do have this space somewhat in my sphere of knowledge. I know software quite well. The advertising space within these companies, I know that well. So I understand how things operate, but I can't tell you that, hey, AI for sure is going to affect them or for sure it's not going to affect them. I think there is some kind of gray there where, yeah, I could see it being a risk. I could see it also being an opportunity. And we're just going to need to let it play out. Analysts, 12 of them are covering this stock. They think the growth is going to continue in 2026. 2027, not bad growth. The revenue is pretty good, chunky revenue. Profitability is going to really expand. P ratio is really low. Man, that's low. So this is a higher risk stock, but it could come with higher rewards in the next 12 to 24 months. It could also come with further losses. Okay. And that's what we're dealing with here with Zeta. I think it's a highly discounted business because it's doing what it's doing. It's got great rates of profitability, cash flow, all those things that I love seeing. Analysts think it's highly discounted. So let me kick it over to Daryl. Let's see what he's seen in the charts. See if he's got any observations that we want to note.
So I have a couple of downtrend lines here. This one at their peak on the 11th of November, connecting to this spot. They've come up and tested it 2 times, broken down below it. And then I have this upper one where we're connected to this high because that's going to act as a resistance point on the way back up. Let me step in now that you've seen where those lines are. The 200-day has stopped bottoming out, but the 50-day has rolled over and heading south. The 21-day is also heading south and cut across the 50 and the 200-day. I'm also looking at this price rise. You said that they're announcing earnings next week. I'm seeing this price rise here, but I am looking at this volume right here. Oops, let me get the right button here. Let me erase that and do this a little better. Look at this. Oh, geez. I'm going to get it here. I just want you to be able to see this volume right here. So basically what this is telling me is, yeah, the price is going up, but nobody cares. The volume for the last 4 days as it's moving higher is way below the average over the last 50 days. So, yep, price is going up, but nobody cares.
The way I would view it is price is going up, but there's a lot of investors who are going to wait and see.
Yep. What I'm saying is be careful going into buying this before the earnings.
I agree that this is a high risk situation. If you're right, you're going to feel good, but they could have good news and this stock sells off.
Yep.
And that to me is irrational. Okay. Like we're talking about, Target, how the sell off to me, hey, that made sense. You don't operate your business right. You don't grow your business. Market sells off your stock. That's how it should be. But Zeta can come out and say, hey, we grew even faster. We made money. And OpenAI comes out with some new model that says, oh, this model is going to be yada, yada, yada. And the stock sells off 10%. And you're like, geez, man, the company's doing great. And the stock sold off. So that's what you're dealing with.
Yep. So we have an RSI that's not quite back to 40 yet. We've been on a sell signal since the 16th of January. The signal, or not the signal line, the average over the last 12 days has started to level out. Getting closer back to the signal line, a crossover above that red line would be a buy signal. Money flow is sitting right here in dead neutral. So be careful with this one, I think. It'd be a gamble, in my opinion, going into the earnings on this one.
Well, hold on a second. Mike, the dividend investor guy, is breaking hot new news. The market's turning green. What's going on, Daryl? Did the Tooth Fairy come into the picture and say, hey, stock shall rise? Or because we were kind of just bumping at zero. And what's going on? Dow slips after week.
Yeah, the Supreme Court was going to announce on the tariffs today, so maybe that got released. Tariff ruling at 10, so that's, if that's Eastern time.
That's right on the button.
Yep.
That's probably what's being reported.
Mike saying it's a little bit later on tariffs. So I don't know whether it's 9 or 10 Eastern time.
Oh, okay. Okay. All right. Well, maybe one of the Supreme Court judges was at local Starbucks and talking to a friend going, oh yeah, we're gonna do this with the decision. And next thing you know, boom. But of course, I'm just kidding around. All right. So we had a question from James, and I think this one's right up your alley. Let me try to find that question here. So, all right. Can you quantify the cup? So I think you showed like a real good example of a cup and handle. If you can take a peek at that.
Yeah, so Coke. You don't want them to be too terribly short. So this is only like 5 weeks, and this was like 5 months. So this one's probably going to be a little less reliable than a longer base. I also just invested in Pulte Homes, and they basically have a cup that started in December of 2024. It finalized the cup on the 8th of September, so almost a full year. just a few months shy. Now, this one's a little questionable because the firing, the trigger, took quite a bit longer than normal. I usually like to see a cup and then it fire, or a handle and then it fire pretty quickly. This one has taken basically since September. We got the handle, and then to fire took another couple of months. So
I have a
I don't know
question when
what
you're ready for one.
yeah, I don't know what to think about this one. I have a price target on them of 192, but I don't know how reliable that one is going to be compared to what we were showing on Coke. Okay, go ahead with your question.
So I think on previous streams, sometimes you see a cup form and it's kind of a longer time frame. Maybe the cup formed over 9 months or maybe even 2 years. And you see that cup kind of form, and then you see your handle. And I think I heard you say that, let's say we saw a cup form over 18 months, then I believe your conclusion was this is going to go higher for some time because it formed over a long period of time. So it's going to rally for a long period of time. Did I get that right?
Yeah, there's someone that has a famous quote that says, "The longer the base, the higher in outer space." And that's basically what they're referring to. So I can't think of any examples right off the top of my head, but if I dug around a little bit, I could probably find some.
I just wanted to lock in that was my understanding. And
Yep, that is
yeah,
true. And that's where
okay.
that quote came from. So the longer these cups are, uh, the more probability or higher probability you have of it really going higher. A cup
Mhm.
like this may be only
Higher
successful.
for longer. Like if it's
Yep.
a long base, it took a year to form. Hey, it's probably going to rally for a period of time.
Yep. So these don't always work. I've got plenty of cup with handles that failed, but these work about 60% of the time you'll hit your target, and 65% of the time you'll at least move higher. Maybe not to completely to your target, but you will move higher. So it's giving you an edge over flipping a coin, 10 to 15%.
All right. All right. I got breaking news, Daryl. Dow jumps 100 points after Supreme Court knocks down Trump's emergency tariffs. So there was a judgment there. So businesses, I imagine that, of course, Amazon's going to pick up a bid because there's so much stuff sold on Amazon, right? Now, all those vendors are going to be able to make more money. And the next question I have is, will there be a refund? Do you, is, is a refund potentially in the works? is
A refund on the tariffs?
Yeah, like Costco is an example. Hey, we paid, you know, this is totally made up number, but Costco is in a position where, like, hey, we paid $5 billion in tariffs. We should receive a refund because that tariff was basically deemed to be illegal. Is that going to happen?
Costco actually has a lawsuit filed for that in preparation, I think. I don't know how in the world they would do that. I'm telling you, it'd be a mess, I think.
Yeah. Uh, is Costco going up today? So Walmart's down, Costco's down. Okay. Um, Amazon's up nicely. Go Google. Go Meta. So software stocks are working. Looks like Home Depot is probably happy. I mean, Home Depot. I shop at Home Depot quite a bit, and I'm going to guesstimate 70% of their catalog is made in China. So they're like, all right, cool. We can keep our prices the way they were a couple years ago. Lowe's is going higher. Okay. And if we don't have tariffs, right, it's also going to help the inflation matter. So,
They're not going to get rid of tariffs. The second if they rule against the IEPA tariffs, they already have in place the tariff using other laws. So it's going to affect them a little bit, but they already have in place what they're going to do with other laws. So they're going to come right back.
okay. Okay.
This is only the IEPA tariffs.
All right. So we'll see how that plays out. Let me catch up. But whoa, man, we got a lot of people on the stream now, a lot of comments coming at us. So let me catch up on comments. We're going to move to BSX.
Let me add one more thing to the cup with handle and the base. So gold formed a 10-year base. I'm looking at Gemini here.
Yeah. See, that's why I was asking, because I remember you expressing that. Keep going.
Yeah. So this was a multi-decade base. So they can go for a while. The outlook, they're projecting as high as 3,000 to 6,000. So I'd have to go look at the actual chart, but anyway, there's a question that, multiple years.
And does Alan Shaw, is he the guy that said the longer the base, the higher?
No, it was probably somebody like William O'Neill who documented the cup with handle.
What was the expression? The longer the base,
the higher end. Space? Well, Guy Adami on Fast Money, he always corrects anybody that says the higher in space, because the woman that he quotes, that I guess used the phrase a lot, was higher into outer space. So he always makes sure to correct people when they don't get it right. But I'm not seeing a female name in here associated with that. So I'll have to listen next time he mentions that.
The bigger the base, the higher in space.
Yeah, it's actually outer space is what Guy Adami always points out. So I don't know who's right. Some of these things develop a life of their own.
Okay. We're going to need an aeronautical engineer in here we're going to need to add a third member of the stream that could get us to term all that stuff right. All right. Looks like Shadow Guy has made an appearance. Very good. Okay. Okay, cool. So we got the tariff news out there. Ben 10, good to see you. GRAL dropped like crazy. You know what also dropped like crazy? What was that stock? Too many stocks. Too many stocks bouncing around my head. Let's continue on. We're going to go to BSX. BSX. Boston Scientific Corporation develops, manufactures, markets medical devices for the use of various interventional medical specialties worldwide. It operates in two segments, med surge and cardiovascular. Okay. So the med devices, healthcare, a lot of employees. And man, healthcare has just been getting slammed lately, but look at this chart. Going up nicely for a while, and then it peaked, and then it's just been a trail of tears in the last 12 months, especially last 3 months, no bueno, and year to date, not good. February 4th, they announced, so there's probably some news there that really sent the stock to, going down. This is a $111 billion market cap company. PE ratio, forward PE, 21.6. That's not bad. We'll see how profitable these guys are, see how they're growing. And I just think there's a discount available on Boston Scientific. Let's take a peek, see how they've been operating their business. This is a big business, okay? $20 billion is a big business. They've been growing nicely looking at the quarter. Now, you see how this stepped down in the revenue growth. So I think the market did have an issue with that step down. Like, hey, you're not going to grow like you were growing before. What's going on? You're losing pricing power. You're losing unit sales. And the cost of revenue went up. Maybe those tariffs are eating away at Boston Scientific's, overall margins. They still are very profitable. So that's good looking profit ratio, 70%. So that's very good. Profit margin overall 14.4. That looks good. So I think that step down in growth created some bad vibes. The investing community was like, whoa. If you're not going to grow like you were growing before, we're getting a little scared. And I like scared markets. I make a lot of money in scared markets. All right. So looks like Stock Analysis kicked me out. I don't know why. I am a full member. And I'll log myself in a bit. So it looks like they're going to grow in 2026 by 12 and then 10. That is a little bit of a, hey, hold on a second. Your growth rate has dropped in half from a percentage perspective. And this is a very mature business. It's not like, hey, they're a startup and so forth. And they're going to grow their profits nicely, bringing down their PE ratio. But I think this is beginning to have maybe some investors that are more growth oriented leave the stock and say, oh, I don't want to be in a stock that's going to grow at 10%. I wanted to be in a stock that was growing at 20%. So that might be some of the investors exiting the position. So I'm going to take a peek and see if I have a valuation on these guys. And I'm going to kick it over to Daryl to take a look at the charts.
Okay. I didn't have a save chart on this one. So the first thing I do when I pull open a chart is I usually go back over a longer period and I try to find a location where the price has kind of quiesced, even though it's much higher than that right now. Over many years, at least 3 years, it kind of quiesced around this particular price. So I just like to get an idea where that is. And this one had been increasing. We did start rolling over. We are in a confirmed downtrend because the 200-day is declining. So the 200-day average, which is basically a year's worth of trading, is starting to decline. Every single one of these averages are in the wrong order. So you have the 50-day below the 200-day, it's declining. The 21-day is declining. The 5-day is increasing, but below the 21-day. We had a big sell-off on the 4th. The selling continued. Actually, some optimists came in the next day and drove the price a little bit higher on pretty high volume. But then the next 2 days after that, 3-4 days, the price continued to go lower. And now we're trading below average volume. I do see the RSI is oversold, so we're at a level of 28, 29. We had a confirmed buy or sell signal on the 3rd. The 12-day moving average is starting to improve and looks like it could cross over the signal line here shortly. The distribution started 2 or 3 days before this big drop, so that was kind of a warning sign here when you can see the distribution kicking in before the actual drop. And I can also see there was some above average volume before that big drop. So somebody was suspecting something here was going to happen. And sure enough, it did. So I don't think that one price is totally out of range. It's already reaching a low that I see from 2024. It's testing that. Maybe it'll find support there. I'll tell you what I'll do is I will add another auto support resistance right there because it is finding a little bit of support there right now. So what I would say, in my opinion, that if it breaks down in a sustained fashion below this price, then that other one could come into play.
Interesting. And let me flip it back and show the valuation on this stock. And then we're going to come back and talk about how I think you have figured out how to dodge bullets. And I'm referring to MPT. All right. So Boston Scientific, it has a discount. It has really strong fundamentals, but that reduction in growth or the slowdown in growth is really what's creating the tension and really limiting the value of this stock. The stock is fairly priced on cash, and it's priced at a discount based on earnings per share, on average 11% discount. That's not going to float my boat, especially if we're seeing a sell-off. Now, put it in the app on the rationalstocks.com website. If I use the base numbers, and this uses Yahoo Finance figures, it actually calculates this stock is really overpriced. So for me, Boston Scientific it's got to settle down. I'd probably give it a quarter. I would really like to see what they have to announce in 3 months. And maybe at that point, see that, hey, market's overdoing it when it comes to the sell-off. Or market was right, man. Geez, Boston Scientific has to be repriced. It's not worth as much as we thought a year ago. So that is Boston Scientific for Mitch and Ricardo. Thanks for asking. Interesting stock. Now back to MPT. Did you dodge a bullet on MPT?
Yeah, so the Supreme Court did strike down the most sweeping tariffs. So, wait for the games to begin here.
Okay.
MPT, this has not been my proudest moment. Let me see if I already have some charts on it. Nope, I don't. So this has been one that's a little tough. So I was trading it back in 21 or so. It was doing pretty well, and then they had some bankruptcies with some of this is a REIT. They own hospitals. Stewart Hospital ended up going bankrupt. So I just kind of gritted my teeth and sold options on this and what have you to kind of dig myself out of a hole. Yesterday, they do tend to get meme-like at times. So you can see that they'll bounce up. I thought there was some more exaggerated views of this. So yeah, shooting up to $8, and they'll shoot up above their regular price. So they kind of act like a meme stock sometimes. But anyway, yesterday, yeah, when they shot up, these don't tend to last very long. So I sold right at almost the very top yesterday. I sold at 642. Not all of it. I still hold some. But I sold about 200 shares out of my 800 or so that I own yesterday.
Yep. That's
so basically the longer you hold a stock, the more you get to know the stock.
Mm-hmm.
And that can come into your favor. So I know that used to be MPW. Now it's MPT. I never knew why it was MPW because their name has always been Medical Properties Trust. And why they got a W in there, I'll never know. But anyway, they finally changed it to MPT. But once you've been with a company for a while, you kind of learn how it trades. And I just knew that this wasn't going to last. So I just took an opportunity to sell a couple hundred shares almost at the high yesterday.
All right. Thanks for covering that, Daryl. Looks like I think Mike was asking about Hercules Capital. I like the name, by the way. Pretty cool company name. So these guys, they're a business development company, firm specializing in providing private equity, venture debt, growth capital to privately held venture capital backed companies at all stages of development from mid venture to expansion stage, including select publicly listed companies and select special opportunity companies that require additional capital to fund acquisitions, recapitalizations, refinancing, and established stage companies. Okay. So asset management, financials. Wow, really sold off. So this one here has not worked. It pays a huge dividend. 12%. Wow. It's a big dividend. Can they afford that dividend? They're paying out pretty much their 100% payout ratio. So these types of businesses, I'm always, I'm not a big investor in these because I just don't see what they're doing. I'm kind of giving another team of investors money and then they invest it. And to me, just my preferences are I just don't like that. I don't like being in that position. If I'd rather be the investor. So, but I get that they're providing liquidity to privately held companies, which might be a good idea, especially as we get these really valuable private companies like OpenAI and SpaceX and so forth. They have been growing. That looks good. Growing nicely last 2 quarters. That looks good. And yeah, so it has potential. And man, that dividend is massive. Analysts think it's discounted by 23%. And they're expected to grow. So I don't have a strong opinion on this one way or the other. What do you think about Hercules?
So I don't know this company specifically, but I keep up through ARCC and Blue Owl and BlackRock, etc.
Mm-hmm.
So these companies in general had a big sell off right here, and this was all about credit loss potential. And if I looked at ARCC, I would see a very similar chart, recovered. And then BlackRock, one of their funds, they had to restate their book value or their net asset value, and it was 19% lower. So that fund, I put out a video on this, but that fund, because of that credit worries again and the potential of having your NAV reduced, sent all of these stocks down again. Once again, I could look at ARCC and I would see the same exact thing. Can you look up the book value on this one just so we know what the book value is?
Sure.
So they made a little bit of recovery, and then yesterday, Blue Owl Capital, they have OWL is the management company, OWL. OBDC is their publicly traded business development company. Then they have a private company, and it's OBD. Can't remember what the last letter is, but that's the private piece. That fund, they froze everybody's withdrawals yesterday because they were running out of cash. People wanted to withdraw their funds based on these credit concerns. So they locked up the fund and they had to sell a big portion of their loans to raise money. to allow people to withdraw their funds, and that was this impact right here.
Hmm.
So whether you're Blue Owl or not, and like I said, I could go look at ARCC and the chart would probably be a carbon copy of this one. Just I know a lot more about ARCC because I've been trading them for a long time. I don't know anything about this one, but what I just explained is what is causing these price worries. So did you get a book value?
I do. So the book value per share is $12.28. The stock's at $15.62. The price to book is 1.27, which is lower than what these big banks currently have, which is 1.7.
Yeah. So I think ARCC, let's just go look at it. I'm a lot more familiar with ARCC. So chart doesn't look exactly the same, but the same thing applies. Here was the credit loss concerns. Here was BlackRock fund having to restate their NAV, and then here is Blue Owl Capital. So this one has a book value of 1984, 1994, right around there. Let me go and look. I have it annotated here. 1988. So I was wrong on both cases. So they just reported it was at 20. Now it's at 1988. That's better than a 19% reduction like BlackRock had. But if I just move to my trades on this one, I can show you. I tend to buy when it's below NAV. So I keep a track of this NAV with this aqua colored line or cyan colored line. I sell when it gets too extended above it, and I buy when it's below it. So that's how I trade these BDCs. And they're trading at 1911. I have 2 contracts for puts at 19. I thought I was going to get exercised on those today, but it's trading above 19. So I'll get to probably keep the premium on that particular 2 contracts.
Okay.
So I trade options and I buy under NAV and sell when it's over NAV.
All right. Thanks for doing that. And one thing I'll point out is specific to HTGC, the dividend has come down a little bit. I mean, it's varied a little bit, but they have been trying to stay around the same amount. But I imagine if things get tight, this dividend is going to be slashed. And I would support that, by the way. If I was a stockholder, I'd be like, hey, you got to keep your balance sheet solid. Even though slashing your dividend is probably going to make the stock really go down. So that's Hercules. And then CSWC is similar Capital Southwest Corporation. They're a similar business. They haven't sold off as much. They pay a high dividend, and their dividend is more volatile. It's been kind of all over the place. 64 cents a share down to 19, 25, 25. So we'll see where the dividends go with these companies. And these are small cap companies. Interesting. All right. Somebody mentioned GRLA. Before I do that, we talked about Zeta earlier. Discounted stock. It's up 3.64. Maybe it started to go higher. It's up 8.5. It's going to announce next week. Interesting. So GRAL, commercial stage healthcare company, provides multi-cancer early detection testing services in the U.S. and internationally. It offers Gallery, a cancer screening test for asymptomatic individuals over 50 years of age. That sounds like a good thing to do or have or be a part of. Okay. and they announced earnings yesterday. All right. And wow. Oh, man. If you're a big investor in this company, today is a dark day. It is a very dark day. Down 47%. Oh, man. And it's still up 1% over the 1 year. But they announced their earnings yesterday, and their trial missed. Main goal. So this one here is just getting torched. All right. So looking at the market.
I want to look at the chart on that one too.
Okay. Let me kick it over to you, sir.
And the reason for that, you notice how I keep these auto resistance lines over time is for exactly this reason. They do come back down occasionally to get back to that quiescent price. When you see a big run up like this, it's not uncommon to come back and test that price at some point. So I just wanted to point that out. That's why I spend time showing you guys those auto resistance lines, because it shows where the stock trades a lot of the time. It's at that price.
Tough one. Yeah, that's why we want to diversify. We want to diversify, spread our risk among some of these high risk stocks. And, you can't get that much hurt if you're diversified. It'd still be a horrible day to be an investor, but you can limit your portfolio's drop by diversifying. So things are beginning to show what the theme is of the day. Google is up nicely, 3%. Meta's rising. Amazon should be rising on the news. I know that it's going to get kind of noisy on, well, if we can't do the tariffs we were doing before, we'll come back with this other form of, I guess, punishment for countries that are not supporting particular whatever, right? So as I would expect, some of that retail is doing well. I'm surprised Walmart's selling off. Target's higher. Walmart's deep red. I did do a video on Walmart earlier this week. View it if you'd like. And Costco's down a little bit. What is DLTR? I don't know what DLTR
Dollar
is.
Tree.
Oh, okay. So now instead of spending $1 on an item with less, tariffs, you could spend like 92 cents or something. Then we got railroads, maybe they're going to crank out some more. Railroads have been doing well. They've been going up. Some software stocks are picking a bid today. CRM, Uber, Intuit. Okay, good to see. These guys have been punished. These guys are guilty until proven innocent for a while. We'll see. So should be $1.25 tree. Kind of side story. It's been a while, but man, I hate change. And the reason I don't use cash is change. And my dry cleaner, it's a small business. They work so hard. Good place. They accept check or cash. And I always pay cash, but they have a tip jar. All the change always goes in there. I just don't want to accumulate change. It's such a hassle. All right. All right. So we got the stock market rolling. That's a good place to kind of land the plane. So what's going on with your
Shadow Guy has a question on book values.
Non-accountant question. Does every company have a book value? Because I notice you only use it for value banks. The answer is yes. Book value is all your assets minus all your liabilities. So that's a ratio that you can determine for any company. Now, when it comes to big banks, the reason you want to do it is, okay, you have a bank, which it's its business is to lend money, right? That's like, for example, Caterpillar. Its business is it buys materials, it hires really good people, it manufactures a big machine, big bulldozer, big earth mover, then they sell it. Now, a bank, they're like, hey, we take deposits, we lend out the money, the net interest margin is the money we make. So we want to make sure that the book value is always at a good place because we wouldn't want the assets of the bank to be really low and the liabilities to be really high. So we want focus on book value with that respect.
And then
Anything you want to add on?
if you go and look at the book value for Microsoft, because they don't have a lot of their assets are software, and it's hard to price that. So if you go and look at the book value for Microsoft, let's pull it up.
Price to book 7.57. They'll never make it as a bank.
Yeah. What's their actual? Go to their financial balance sheet.
So the book value per share.
Let's look at the price per share.
So book value per share, $52.61.
Yeah. So that's why we don't pay much attention to that for NVIDIA and your tech companies. There's also a tangible book. So that's stuff you can put your hands physically on.
Mm-hmm.
The book value can typically include stuff like brand and that kind of stuff. We don't look at it for Googles and Amazons, but we definitely look at it for banks and BDCs, etc. You have to know what their net asset value is.
The stronger the moat, the competitive barriers that a company has, the lower their book value would be, because a lot of the value of Microsoft is somebody going to come into the picture and start competing against their Windows operating system software? Not soon, maybe some year, but the whole network power they have, like how many PCs are globally out there and so forth and so on. So that moat's really high for Microsoft. They also have their Azure business, really high moat because of their market share. And it's very hard for customers to move from Azure to some other cloud. So the higher the moat, the higher the book price to book ratio would be. Let's look at NVIDIA. I bet you that one's going to be a terrible price to book. But we could say, well, they have these patents. Price to book 38.4. But NVIDIA has these patents on GPU technology. It is what the world wants right now. So they basically, the value of NVIDIA is the future projection of all the revenues they're going to get, all the free cash flow, and the profits on those GPUs are going to sell, that they sell at 75% gross margins. All right. So we just talked about book value. Good question. Thanks, Shadow Guy. Looks like we've got a coin collector out there. Hopefully you have a bunch of gold coins. Cool. Got some coin collectors out there. All right. So what is going on with your channel, Daryl? Anything you want to highlight?
So if you're not a member of my channel, let me share my screen just so you can get to the QR code if you want to scan that, or you can just go directly in YouTube to hear. The last full video I did was just my weekly stock chart analysis, where I look at charts that have some interesting things going on, or if I made a purchase or did a sell and why I did that based on what I'm seeing on the charts. And then I also keep track of all the earnings. It's somewhat interesting that the earnings have actually come in line with what the expectations were for about I think it was about an 8% earnings for the first quarter. These companies that I own have actually been up 14%. So it's kind of in line with what I've been hearing about the earnings expectations for the year. And then one other kind of interesting thing is despite the number of beats, which is actually a pretty high number, the actual responses have been somewhat muted. So that's why you're seeing stocks that have good earnings, and then you see the price go down because that's just kind of the quarter that we're having this time. And I also put out shorts on all of the companies that'll be reporting this week. Those will be coming out shortly. I'll tell you what the relative strength is, what the trend is, what the revenue and earnings estimates are, and the implied move calculation. I'll share that. And these are just 1 minute long.
So I noticed something. So just real quick, for all you members out there, I've been creating videos. I hope you found them interesting. And Walmart, I released yesterday, Instacart a couple of days ago, Airbnb, for super investors, my whole portfolio review, and then Coinbase, which FYI, don't be surprised if Coinbase is a 5 to 10 bagger in 5 to 10 years. I think their business is setting itself up to be a big powerhouse in the future. Applied Materials. So I've been creating a lot of content for members, and then I release it 30 days later to the general audience. And I've also have been putting a lot of time into shorts and creating shorts for members only. So it doesn't show them, but for example, Oxy's member only, eToro's member only, and then 30 days later I release them to the general audience. I wanted to show, where's crypto going? Crypto's a little bit higher, but for some reason Coinbase is really high today. What's causing that rally? Robinhood's higher. I guess just a lot of trading is going to be happening with the news that these tariffs are maybe going away, or they're going to be redefined. Google, go Google, 3.5. Well, what's going on in Google land? Amazon's higher. Very good. Okay, so I'll take it. Energy's losing a little steam. The midstream. That's one of your stock on the contest, right? That's a midstream player.
OKE, yep.
Yeah, so it's probably doing well today. Railroads keep going higher. So interesting day. Nvidia's higher. Qualcomm a little bit higher. Micron is higher. One of the videos I'm going to create is it's probably going to happen over the next week, is I'm going to look at memory, and Micron's going to be in there, as well as like SanDisk and so forth, because it's been incredible to see those stocks rise. But at what point are they going to start melting down? I think it's going to happen. It's just no way around it. There's a shortage of memory, but it just seems like every memory company is probably going to be cranking out supply, and the price will at some point really begin to fade. And I'm going to do a video on that. So look for that video. I'm also going to do videos on super investors. That'll happen over the next week. I'll take a look at the contest. Let's take a look at the contest rankings right now. Whoa, CCOE. Look at this, how this changed. CCOI was in 4th place, and things changed really quick. Genetic Smite, I think he's on the stream right now. He's like sipping tea in 1st place. And Oxy's doing well. Nebius is doing well. OKE is doing well. IREN's doing well. I started buying into IREN, just small position, but they control their electricity, and man, I think they're in a good spot. So there's some stocks that are really doing well this year. Alibaba is doing well. So I'll do a video to summarize, what's going on with the contest at the end of February. All right, so let's end it there. Good job today. It was a really interesting conversation today, Daryl. Thank you so much. Nice work.
Thank you. Thank you.
And thanks to everybody who joined the stream. I hope you have a nice weekend, and good luck with your investments today. Hopefully you're in a lot of these green boxes, making money, going into the weekend, feeling a little wealthier. I hope that's the case for you. And tune in next week. We plan to stream again, and we'll put out the schedule. It'll probably be, unless Daryl has something he has to do other than the stream, we'll try to stream Monday, Wednesday, Friday, and keep to that schedule. Some days we can't do it. Like last week, I think I was actually in New York. Couldn't stream Wednesday. And when those things come up, as I hope you can understand, life gets in the way, and we can't do the stream. But I really enjoy this live stream. I think I learn a lot from it. And I get a lot of ideas from you guys, the attendees. I've made some good investments because you made me look at a stock that I wouldn't have looked at because it's outside my wheelhouse. But we look at it and I'm like, hey, this is a good looking company, or the situation's really setting up well. So it's just a really good idea generator. And we built up over time almost 400 tracked stocks. I hope we get to like 1,000, and I hope we can start tracking the whole S&P 500 in the, like, here are all the valuations we've done. And when we look at the watch list, this is up to like 375, 380. And it's just going to keep growing. And I hope through the website, continue to work on it brick by brick. You guys could start working with the tools, and then together we can build it up to, I don't know, a couple thousand of these stocks that we can value, and then use it as a repository of, hey, this is what these companies are worth. That'll be fun to do. So we'll see how that plays out.
Shadow Guy, if I'm singing that in my head 2 hours from now, I'm going to come chase you down, man. He's putting an earworm.
All right, so let me put you to the test to see if you know your rock and roll. Who sang that song?
Everybody's working for the weekend. Who sings that?
Loverboy.
There you go. I should have known that.
But all right.
It's a good song, man.
It is. Rock and roll is harder than stock investing, because Loverboy had a couple of good songs, but not much after that.
Yeah.
And it seems like they were talented. It's unique to see like let's say a band like U2. They've been making good music for 40 years.
Yeah.
50 years. It's like, geez, man, those guys keep putting out good content. Sometimes you get these bands and they put out a really good song, and that's it. One and done. All right. So enough music stuff. Wrong live stream. We're going to have to start a different channel for that. Thanks so much, Daryl, for everything you do. Really interesting live stream. Everybody, thanks for tuning in. Good luck today with your investments. And I look forward to seeing you guys next week. Take care.
Take care, everyone.